Hi, everyone. Thank you so much. So excited to be here with y'all. Before we get started on talking about each of the loan programs, which I'll cover, I wanted to explain a term that you may or may not have heard of before called mortgage insurance, because a lot of times the difference between the different loan programs references the mortgage insurance. And so just to explain that, because a lot of times when I talk to first-time home buyers or home buyers in general, they often are worried about that terminology. And so mortgage insurance protects the lender from any default in payment. They're not saying that you're going to default on your payment, but this allows you to put less than 20% down if you're not doing a conventional loan also. And to put less than 20% down and still be able to qualify for a home loan. So there's every loan program structures the mortgage insurance piece a little bit differently. So when I talk about the different loan options, you may hear me reference how that mortgage insurance piece is different in each loan program. So just wanted to make sure I get that out of the way. But if you have any questions about that, just feel free to stop me and I'm happy to explain everything a little bit more, okay? So we'll get started by talking about conventional loans. So typically this is the loan program people hear about the most, and they think, oh, I need 20% in order to down payment in order to qualify for a loan. Well, actually, as you can see from this slide, you can put down as low as 3% down in many cases. Some of that depends on the household income and if you're a first-time home buyer or not. But typically for conventional loan, you can put between 3 to 5% the lowest, which is great. The mortgage insurance piece that I promised I would go over, with conventional loans, once you reach 20% equity in the house, you can request that insurance, the mortgage insurance piece, to fall off, thus leaving you with a potentially lower payment. So that's a great way to think about it. The next one is FHA loans, I think. And FHA loan stands for Federal Housing Administration. That usually requires a 3.5% down payment. The way that they structure their mortgage insurance is that you have an upfront and a monthly mortgage insurance, and that stays for the life of the loan. The biggest difference between FHA, that's the biggest difference between conventional and FHA loans. FHA loans also tend to be a little bit more credit forgiving, I would say, meaning that if you had what we say a mishap in the past and you've recovered from that, they tend to be more forgiving of that. Their waiting periods tend to be a little bit shorter. So that allows people to recover a lot sooner. So that's again, a great option. And we see a lot of first-time home buyers go through that program as well. Next up, I think, is USDA loans. USDA loans stands for Department of Agriculture. I know probably you're thinking, what? USDA, isn't that for our food? Well, actually, they also offer great loan programs for people who maybe want to live off the grid. In our area, if you're thinking in Hampton Road, that tends to be maybe in the areas a little bit further out, like we see it in Suffolk, Smithfield, a lot of times. Those areas are considered rural. And so the big thing with that is that both the house and you, meaning the income limit of how much your household make, has to be within the limits of USDA. So you have to be in the gap between those two things. Like you have to be below a certain income limit, and also the house has to be in a rural area. The great thing about that is that it's a zero down payment loan program, and there's no monthly mortgage insurance. Or that mortgage insurance, the monthly mortgage insurance is very small. It's very low. I don't think it's a no monthly mortgage insurance. I think it's a very low one though. So sorry about that. Next up is VA loans. And this is for our veterans and active duty military. Also allows you for a zero down payment option. And the great thing about that is that there's no mortgage insurance. There is something called a funding fee, which can be added back into loan. That's kind of like their upfront mortgage insurance. But again, it's a great option for our veterans and active duty. And we obviously in this region, we see a lot of VA loans. So that's about these programs. And I think, Lori, I think you're taking it away.
Thank you, Shikma. We really appreciate you giving us an overview of those loan programs. And we're going to roll into having Miss Lori Walter come down to the virtual stage so she can give us an overview on the renovation loan programs.
Hello, everybody. Shikma said something in the beginning about making loans fit your lifestyle. I think that's a great way to explain renovation financing. Renovation loans are available to current homeowners as well as people looking to purchase a house and wanting to fix it up. We've got fixed and adjustable rates, and we're tied to FHA limits. As Shikma said, FHA is Federal Housing Administration. So these are government-backed loans. So they've got lower credit score requirements and the qualifying is a little easier. They are for owner-occupied properties only though, but they will allow you to purchase up to 4 units. So if you're really lucky and find a duplex or a triplex that you love and you're going to live in one of the units, it would be a way for you to purchase that and have your personal residence as well as some income coming in from the other units. Next slide, please. Oh, before I think one more thing. On that 203K loan, I don't have any zero down options on a renovation. However, if you happen to find a property that is owned by HUD and it's a foreclosure, they will allow you as a buyer to put as little as $100 down on those properties, meaning that you could buy a house and finance your renovation costs and your down payment would be $100 instead of the normal 3.5%. That's not available on any of the other loans, only on the FHA, and it will also work with the renovation financing. So it's a good thing to keep in mind. So what exactly is a 203K loan? It's a renovation loan. It's a fully funded mortgage. So when you find a house that you like, you're going to come up with a renovation budget. Whatever your budget is, which would be your contractor costs, your contingency fund, and any fees that might be due, that's added to your loan amount, and your down payment would be based on the total of those figures. At the end, and once you close, all of your renovation money is pulled out, it's put into escrow, it's held there by the investor while your contractor makes the repairs that you've decided you want done to that home. You are taking advantage of future value because the loan's going to be based on the value of the property when the work is completed versus in its current state. So if you're adding an extra bedroom or you're updating kitchens and bathrooms, they're going to appraise the house as though you've already done that versus how it sits with a 50-year-old kitchen possibly. It is not an open-ended loan. It is a closed-end loan. So it's important to know that you want to get a price for everything that you want done on that house up front. Doesn't mean you have to finance it all, but let's make sure we're covering all your bases, because once the loan closes, we can't go back in and increase the budget. So whatever it is what it's going to be. Everything, all loans for your funds for your escrow are dispersed at closing. Your contractor can begin working the day that you close on the loan. You have up to 6 months to complete all of the work, and the contractor would make draws on against the escrow. Next slide, please. So the difference is under FHA 203K, there's two loan programs. One is called a standard 203K. The other is a limited 203K. The difference is what kind of work you're going to do and what your budget is. The limited 203K is going to be limited to non-structural repairs. So that's going to be kitchen and bathroom remodels, new roofing, new mechanicals, plumbing updates, that kind of thing. And you're also going to be limited to a total budget, which again is your contractor costs and all ancillary fees cannot be any higher than $35,000. But they still have 6 months to complete the work. It's just limited in what you can do. On the flip side of that, the standard 203K does not have a limit. It has a minimum of $5,000 in repairs. But let's say you're buying that HUD foreclosure and it's been sitting vacant for a year and it's got a lot of significant structural damage. The standard 203K will allow you to come in, and those are the programs you can use to add additions, take walls down from the inside and move them around. Maybe there's problems, structural problems underneath the house with joists and what have you. Those would all be structural issues, and they can be addressed with the standard 203K. It works just like the limited. You have up to 6 months to complete the work. The beauty of it, though, is that if you're doing, let's say you're taking the second floor, you're going to add a second floor and you can't live in the house, it will also allow you to borrow up to 6 months of your mortgage payment so that you're not having to pay rent somewhere as well as a new mortgage payment. So you're not carrying the burden of both. So there's some allowances there that you don't have with the limited program. We also have two conventional programs that we're not going over tonight, but it mimics the 203K. But as Shikma says, they're conventional programs, so the mortgage insurance on those can be dropped when you've hit 20% equity in the house. But they're great programs, and if you have questions, I hope you give me a call. Thanks.
Thanks, Lori, so much for giving us an overview of the renovation 203K products.
My pleasure.
And next up, we have Ms. Charlene Turner, who's going to give us an overview on reverse mortgages. So come on down to that virtual stage, Charlene.
Hi, everybody. Please don't run because you heard the word reverse mortgages. We're going to talk about, hopefully give you some good ideas that they are not the horror stories that you've heard in the past. Most of what we know about reverse mortgages, unfortunately, a lot of us try to learn from a 30-second Tom Selleck commercial or from your husband's cousin's friend's father who had some horror story happen. These programs have changed a lot over the years. Most of the changes have been to protect the borrowers. We're dealing with, when you're talking reverse mortgages, with a vulnerable population. So they look at it to try to do what will protect these borrowers as they try to find the best solution for staying in their home if that's what they want to do as they age. The programs we're going to talk about tonight, you've heard us talk about FHA. Well, this is an FHA program called a home equity conversion mortgage. Difference is, Shikma told you how FHA insurance protects the lender because you're lending a higher loan to value on the property. Well, with a reverse mortgage, it doesn't protect it protects the lender, but it really protects the borrower. With a reverse mortgage, you can never owe more than the value of your property. So you can't get as much money up front because you're not making payments on these loans. You're not required to make payments on the loans. What happens to the interest? It's added to the balance of the loan. So the balance of the loan is increasing, not decreasing. But when it comes time to leave the home, you will never owe more than what is owed on the loan, even if your property value has not kept up with the mortgage balance. That's one good thing with the FHA insurance. The other thing is if you keep your loan for a long period of times, we all know in irregular mortgages, which I call forward mortgages, you have the issue that your mortgage lender may change many times over the life of your loan. If something happens to that lender while you have that loan, and you may have money left in a line of credit available to you, that money will always be available to you. Housing and Urban Development takes actually puts a lien on the property at the time we close these loans, so that money will always be available to you. So to look at the eligibility, who can get a reverse mortgage? First of all, you have to be at least age 62 to be on a reverse mortgage loan. You must own your home. It has to be your primary residence. If you have another home elsewhere that you split time with, as long as the home that you're getting the reverse mortgage for is your primary residence, you can do that. You can have a second home. And we've even had people that are missionaries, and they may go out for a year on a mission for the church. Well, that doesn't mean that your residence is no longer your primary residence. So as long as the property is your primary residence, you can use that. You cannot be delinquent on any federal loans. We do not look at credit scores like traditional mortgages do, but we do look at your credit to determine it's the same thing as the willingness or the ability to repay at some point. In this case, we're looking at the ability to fulfill your obligations, which does not mean a mortgage payment, but we'll talk about those requirements in a second. To fill your obligations, we're not going to set you up to fail. We don't want your house. We want you to live in your house and enjoy it just like you want to do. So we're going to try to help make sure that we don't set anyone up for failure. Property, single family, owner occupied. It doesn't have to be, it can be a 2 to 4 unit home as long as you live in one of the units. We can do condos as long as they are FHA approved condos. We can even do manufactured homes. They have to be after a certain year. They have to be newer, but still we can do those types of properties. Then this financial assessment, what we look at is just, do you have enough money to keep up with your obligations for taxes, for insurance, and to be able to pay utilities and any fixed monthly debts that you have, and then enough money left over to live on? That's what we're looking at as far as ability to not to repay, but to stay comfortably in your home. The other thing is that if there is credit problems, if they're explained, if it's something that happened because of an illness or injury, then we can do letters of explanation and get around those. One of the other things as far as eligibility is concerned, because this is so different from what we're used to, traditional mortgages, the forward mortgages, you get a loan, you make a monthly payment. As you make the payment, your balance goes down. And in this case, you get a loan, you don't have to make a payment. What happens to that money? We're dealing with a vulnerable population. Are they of sound mind to make these decisions? Is there somebody who is influencing them unduly because somebody else wants hands on that money? So you have to have counseling from a third-party counselor. These are FHA or HUD-approved counselors who will speak with people before we even take an application to make sure they understand the program. And they may even ask you crazy questions such as, what year is it? And they're charged with trying to determine if the person they're talking to is of sound mind, can make those decisions to be able to get a reverse mortgage. If there is someone who does have issues that they may have diminished capacity, or they may not even be able to sign their name, there are options to be able to use powers of attorney for these loans. So once you get the loan, what are your requirements? You've got to keep the home in good order. that doesn't mean you didn't paint the living room. That means the porch is not falling down. It's not a hazard to anyone. So that's what the FHA requirements are. Nobody's going to come out and inspect your property unless there's reports that it's been condemned. You have to continue to pay your property taxes and your homeowner's insurance. One of the things about property taxes, a lot of people don't know, is that at age 65, most of the cities in our area have some type of tax relief available. It's based on income and assets, not including your home. But if you meet their guidelines, you can get either reduced taxes or even deferred taxes or waived taxes, so that you're not required to make those payments, but you have to file that on an annual basis. Then you have to continue to own and live in it. You cannot get this and then rent the property. Once the last borrower on the loan permanently leaves the property, then a loan will become due. There is no maturity dates on these loans at all. We have maturity events. And these are 3 of those maturity events: failure to keep it in a livable condition, failure to pay taxes and homeowners insurance, or to leave the home permanently. Those are triggering events for the loan to come due. Technically, there is a maturity, but it's your 150th birthday. So most of us will not see that maturity date. Okay. Next slide. Yeah, thank you. There are a lot of myths and misconceptions about reverse mortgages going around. The main thing is that most people think that the bank owns their house. This is a mortgage, just like any other mortgage. You keep the title to the home, you own the equity in your home. If whenever you leave that property, any equity belongs to you. If there is no equity, you're not going to owe any more than what the value is on the property. Some people think, I can't get a reverse mortgage, I already have a mortgage. Well, it's true, you have to have equity in your home. Again, we cannot lend a higher loan to value because you're not making payments on the loan. Interest is being accrued. And what happens is that interest is added to the balance of your loan on a monthly basis. So you have to leave room for that balance to go up without getting upside down on the property, but too quickly. You can make payments if you want to at any time. You can pay it off at any time that you want to. If you win the lottery, have at it. Go ahead and pay it off. Any money received from a reverse mortgage, it's a loan. It's not taxed. It's a loan. So you don't have to worry about that if you get that enough money to pay out another mortgage. If you take the money to do something else with it, it's a loan. There is one caveat I want to mention here, that if you keep the money on deposit, if you're receiving certain programs, then you may have to be concerned about whether it'll affect your eligibility for these programs. It won't affect anything as far as Social Security because it's not income. But if you elect to keep $10,000 in the bank and you're receiving Medicaid or any SSI programs, you may have problems. So you want to be aware of that before you take too much money that you put into the bank so you have assets in the bank at that time. Let's see, proceeds from the mortgage can be used for any purpose. You can pay off that loan. You can do renovations. Lori gave you one option for doing renovations to be able to stay in your home. In this case, if you need a new roof, let the house pay for the new roof. If you need to renovate the home to fit your lifestyle now as you age, let the house pay for that. You don't need to take your own cash to be able to do that. If you want a vacation home on a beach somewhere and you've got the equity in your house, go ahead and get a reverse mortgage to get a vacation house on the beach. Whatever it is that you need and want the money for, as long as it's legal, then you may use the funds for that. You've worked hard for your home. You've built up a lot of equity in your home. You put a lot of your money into the home, and hopefully you have some cash, but why not take the cash out of the house to let it pay for not only its own upkeep and repairs, but also to help you live your lifestyle. You can take the payments on a monthly basis to supplement your income. You can take the money. I've had a number of people recently who are using it for home health care. That's another option. But any purpose, as long as it's legal, is a good purpose for a reverse mortgage. There's a lot involved in reverse mortgages. And again, you can't get it in a 30-second commercial. You can't get it in a 5-minute Zoom presentation necessarily. If you're interested in more information, what we do is we will do a proposal specifically for your information to see how it would fit in what you're planning to do or how you want to live your life. We'll come out and talk to you wherever it's convenient to do that, explain the program, set you up so that if you want to go forward, you can schedule your counseling and we can go forward with this loan and hopefully help each of you live a better life in your retirement and senior years. Thanks for your time.
Thanks so much, Charlene, Shikma, and Lori. We appreciate you guys sharing your knowledge. If anyone has any questions, please feel free to put them in the chat. If not, if you want to virtually raise your hands, I'll just pause for a quick second before we hear from Ms. Gigi Houchins. Okay, well, without further ado, no stranger to our Gethsemane events, Ms. Gigi Houchins, come to the virtual stage, ma'am.
Good afternoon, everyone. I'm so excited to be back to give you more information about what Virginia Housing can do for you. Shikma talked about these awesome programs that Tidewater Home Funding offers, from the conventional loans, the FHA loans, the conventional loans, VA loans, USDA loans. Virginia Housing does that as well. And Tidewater Home Funding would be the lender that can originate those loans, because you would have to go through an approved lender in order to do Virginia Housing loans. The only loans Virginia Housing does not do, we don't do the renovation loans, which would be the 203K and the reverse mortgage. Very familiar with both of those loans. My brother did a 203K, and actually as a loan officer, I did a reverse mortgage for my mother. So they're both great programs that, that's out there for anyone who's looking to renovate their house, as well as do a reverse mortgage. So what is the benefit for going from doing a Virginia Housing loan? Well, the first benefit is we can provide you unique financing by offering 100% financing. So as I mentioned, these are the programs that we offer. The same programs that Shikma talked about that Tidewater Home has. These are the programs that she would offer if you are a first-time home buyer. So you have the option to do an FHA loan or VA loan, rural housing, or conventional loan. The only difference, as Shikma mentioned, is with an FHA loan, it's a 96.5% loan to value, which means you would have to come up with 3.5% down payment. Guess what? At Virginia Housing, we can help you with that. We can provide up to 100% down 100% financing for that. So we're going to help you with that down payment. With the VA loan and the rural housing loan, we can provide you closing cost assistance for that. And with the conventional loans, we can provide you 100% financing with a loan as well as a grant. Next slide, please. So who is eligible for a Virginia Housing loan? So with the programs that Shikma talked about, you do not have to be a first-time home buyer, but in order to take advantage of the awesome benefits that Virginia Housing has, you must be a first-time home buyer. I will have to say, Virginia Housing, we do have 2 loan programs where you do not have to be a first-time home buyer. You can be a reoccurring buyer, and that's our conventional loans, but you will not be able to benefit from our specialty programs by getting that 100% financing by using our down payment assistance or plus second mortgage. So for today's purposes, I'm going to talk about the benefits of being a first-time home buyer, and you need to definitely take the opportunity to use these programs while you're a first-time home buyer. So who is eligible? All borrowers must be first-time home buyers. Virginia Housing defines a first-time home buyer as anyone who has not owned a house within the last 3 years as their primary residence and lived in it. So you have not owned a house within the last 3 years as your primary residence, and you did not live in that home. So you could have owned a house But as long as you did not live in it as your primary residence, you are still considered a first-time home buyer. So that's the first qualification. The second qualification is it must be your primary residence. So with all Virginia housing loans, this program is for first-time home buyers. So all borrowers must occupy the property. It cannot be a second home. It cannot be a vacation home. It must be your primary residence. And we also have maximum household income sales price limits. Next slide, please. So in this area for Hampton Roads, the maximum gross household income limits in order to be eligible for a Virginia housing loan is if you have 3 or more people in your household. We have 2 income buckets. We have standard, and the standard is if you want to get up to 100% financing by taking advantage of that plus second mortgage, which means you're going to have 2 loans, but I'm never going to say no money down. I mean, it's 100% financing, but you are going to eventually have to put some money into the transaction, meaning with an appraisal or earnest money deposit. But that's a whole nother conversation. But for this purposes, we can set it up where there's no down payment that you would have to bring to closing with that plus second mortgage. And that's based on the standard income. So the maximum household income limit, if there's 3 or more people in the household in Hampton Roads, would be $105,400,000. $105,400,000. That's the maximum household income limit in order for you to qualify for up to 100% financing for a Virginia housing loan. Now, the reduced income limit of $84,300, that means if you want to take advantage of our down payment assistance and closing cost assistance grant, what is the difference? Why is it reduced income? Because the down payment assistance grant, it can be paired with our conventional and FHA loan, but you would have to bring an additional 1% to closing. But guess what? It's a gift. You do not have to pay that grant back. It is a gift. It's free money. At Virginia Housing, we like to give away free money. So that is why at Tidewater Home Funding, if they're talking to a first-time home buyer and if they're within our income guidelines, they're going to try to take them Virginia Housing so you can take advantage of the free money. So that's why the incomes are a little bit more reduced than the standard if you take advantage of the plus second mortgage, because it is free money. Now, the closing cost assistance grant is free money as well, but you can only use that. That's a 2% grant. You can only use that with a VA loan or a USDA loan. So the maximum household income limit for the DPA or the closing cost assistance grant is $84,300. I think those household income limits are pretty good, especially for this area. Next slide, please. So the plus second mortgage, let's talk about that a little bit more. This is where you can get 100% financing. At Virginia Housing, our minimum credit scores for our FHA loan is 620, which means you don't have to have a 700 credit score to get 100% financing, and you're still able to get that plus second mortgage. At a 680 credit score, we're able to give you an additional 1.5% of that for that plus second mortgage to cover the closing costs. So let me just give you an example. If you were doing a conventional loan, the loan to value is at 97%. At Virginia Housing, we're going to give you a 3% plus second to cover that down payment. And if you have a credit score of 680 or greater, we're going to give you an additional 1.5%, which means your total second loan would be 4.5%. And that 1.5% will cover that closing cost. And in today's market, sellers do not want to pay closing costs because it is a seller's market at this point. So that's another advantage why you want to take, that's another reason why you want to take advantage of these benefits by being a first-time home buyer. Next slide, please. Down payment assistance grant. Now, this is the free money I was telling you about. That plus second mortgage is it's a lien, so you have to pay it back, but it's at a 30-year term, and the rate is the same at the first. So you're still looking at a very minimum payment. But hey, you don't have to use your own money to take care of that down payment. But for a down payment assistance grant, you can get a 2 or 2.5% DPA grant, which is free money, which means you would have to come up with only 1% to cover the remaining of that down payment. So in Hampton Roads, the maximum sales price limit is $390,000. So if you found a house with a sales price of $390,000, you can get a grant up to $9,750. Free money. Is forgivable at closing. You don't have to stay in the house for a certain amount of time. It is free money that Virginia Housing is giving with that DPA grant, but we are looking at the reduced income limits for that. Next slide, please. Closing cost assistance. As Shikma talked about, if you're a first-time home buyer, as I mentioned, in today's market with the closing cost assistance, sellers aren't giving it up. But if you are a qualified, if you're active duty, or if you are a veteran, and if you have your VA eligibility, then you would qualify for a VA loan. And with the VA loan, it's 100% financing, but we can give you that 2% closing cost to help you with that closing cost, as well as with the USDA loan. In this area, Suffolk is a rural area. So for a USDA loan, it's still 100% financing, but at Virginia Housing, we can give you that 2% grant to cover that closing cost. And the grant is just like the DPA. It is free money. You do not have to pay that back. Next slide, please. Now, the mortgage credit certificate, don't you know, you want to look at it. You have ice cream, then you have the fudge, and then you have the whipped cream, and then you put a cherry on top. That's how I explain what the mortgage credit certificate. So we're able to provide you with down payment assistance, so you don't have to use your own money. But guess what? What else Virginia Housing is going to do? We're going to give you a tax benefit. At this time, everyone is thinking about taxes. So you can only get this by doing by going through Virginia Housing with an approved Virginia Housing lender. What is a mortgage credit certificate? And I talked about this briefly in the last session. It's a dollar for dollar credit against your federal tax liability, which means you're going to pay less taxes. And that means you're going to owe less taxes to Uncle Sam, and no one wants to pay Uncle Sam. So the credit is equal to 10% of the annual mortgage interest paid. So the interest that you pay on your mortgage each month, because you will have interest, you're going to have principal and interest that you're going to pay. 10% of that you can use as a tax credit, and the remaining 90% you can use as a tax deduction. So every year you file your taxes, you can use this 10% tax credit. I compare this just like a child tax credit, but with a child tax credit, as you all know, that goes away based on the age of your child and your income. So with this MCC grant, with the mortgage credit certificate, you can use it for the life of the mortgage as long as the borrower lives in the home. Now, if you do refinance your home, the MCC is null and void. But if you continue to remain in your home, every year you're able to take advantage of this federal tax credit. It's a dollar for dollar tax credit. So you see all these, the MCC is the cherry on the top. Next slide, please. So Spark. The last session, LaShawn Forts from NRHA HomeNet talked about Spark. This is another benefit that Virginia Housing offers, is a special allocation of reduced rate funding that we make available to local governments like NRHA and nonprofits and housing industry partners to support special needs. So all Spark is a 1% rate reduction. So we're going to give you that first mortgage, the down payment assistance, and on top of that, we're going to give you a 1% rate reduction if you qualify Spark, if you go through an agency that has available funds. So your mortgage must be a Virginia Housing first mortgage in order to take care of these Spark funds. And in the last session, I believe that LaShawn Forts with NRHA indicated that they still do have Spark funds. And for Spark funds, to use the Spark funds through the NRHA, the property must be located in the city of Norfolk. Next slide, please. So as I mentioned, it's a 1% rate reduction. So if the initial Virginia Housing interest rate is at 4.5%, then if you're eligible for Spark, we're going to give you that 1% reduction. That means your final rate would be at 3.5%. Next slide. So here's an example that I want to show you the impact with using the down payment assistance grant. So on the left-hand side, you will see an example without using the down payment assistance grant. Let's just say, you didn't hear about, you didn't come to this presentation, you didn't know about it. You just knew, hey, I'm ready to buy a house. I just want to get a standard FHA loan. And on the right, I'm giving you an example of using Virginia Housing loan program with the down payment assistance grant. So you see the purchase price is the same at $214,000. We're still comparing the same types of loan of an FHA loan, but without using a Virginia Housing program with a DPA grant, your interest rate is at 4.375. But with a Virginia Housing loan product, and if you use Spark funds with that 1% rate reduction, your rate can be at 3.375%. So as you can see, the total mortgage payment with using the DPA grant and with that 1% rate reduction, your payment is at $1,400 a month. That's a monthly save of $120. The closing costs that you would have to bring to cash needed at settlement without using the DPA grant and without that 1% rate reduction, the cash needed at settlement, because keep in mind, without using Virginia Housing Loan Program, you're not going to, you have to use your own funds, is $13,325. And if you use Virginia Housing Down Payment Assistance Grant, you would only have to come to settlement with $7,975. So that's a save of $5,350 that you can keep in your pocket and invest in something else. As well as with the mortgage credit certificate, if you take advantage of the mortgage credit certificate, the first year savings that you will have with that tax credit is $755. Next slide, please. So here's an example of taking advantage with the plus second mortgage. Both loans are FHA. With Virginia Housing, you're still getting that spark of 1% rate reduction. As you can see, the mortgage payment with the plus second mortgage is going to be a lot higher, because we do add the rate is a little bit higher if you're doing a plus second mortgage with a Virginia Housing FHA loan. But still, as you can see, the mortgage payment is a lot lower by someone doing a standard loan product without using Virginia Housing Benefit Specialty Programs. So without using the Virginia Housing products, the mortgage payment would be $1,521. The cash needed at settlement, because that plus second mortgage, we're going to cover that full down payment. You don't have to use any of your funds. The cash needed at settlement is only $2,625 versus if you did a non-Virginia Housing loan, it's still $13,325. So with taking advantage of a Virginia Housing product, you're going to have a monthly payment save of $42 a month. Cash needed at settlement, you're saving $10,700, and your mortgage credit certificate first year save would be $893. So if you're a first-time home buyer, or if you know anyone who's a first-time home buyer, please let them talk about these products. Please let them know about the benefits by using a Virginia Housing product. And they definitely need to contact someone at Tidewater Home Funding, because Tidewater Home Funding is an approved Virginia Housing lender. And if you have any questions, you can always send me an email and give me a call, and I can help explain any additional information that you need. I am the Business Development Officer for the Hampton Roads region for Virginia Housing. Thank you.